Okay, so welcome to the last lesson in Chapter 5. And not only is it the last lesson in Chapter 5, but it's also the last lesson in Unit 2. So, we've covered a lot in Unit 2. I know that Unit 2 is harder than Unit 1. I promised you that, actually. And I know in Unit 2 the concepts are a bit more complicated. So let's just recap the key things that we've learned in Chapter 2, in Unit 2. So we did Chapter 4, and Chapter 4 did a couple things. We learned a debit-credit theory, and we learned to record transactions in a simple ledger called T accounts, where we have the debits on the left and the credits on the right. Do you remember that song? And we learned how to calculate the totals in each of the T accounts. And then to ensure that the debits equal the credits, we learned how to take off a trial balance and how to fix that trial balance if we don't balance. And you guys all know how frustrating it is when a trial balance doesn't balance. So hopefully you remember those steps. And then in Chapter 5, we learned that the capital account isn't a great place to record all of those entries for sales and costs related to the business. So we expanded the ledger or added 3 new accounts. We added a drawings account, which shows how much the owner withdraws out of the business for a given period of time. We have a category of accounts called the revenue accounts, normally called fees earned. The account's called fees earned for the service businesses. And this records all of the sales that the business records for the period, and it's always got a credit balance. And then finally we learned about expenses. And expenses are all of the accounts that relate to the costs of running a business, like rent, utilities, wages. And these are all going to have a debit balance because they decrease capital. So now we're into the last lesson in Chapter 5, which is 5.3. And in 5.3, we're going to, the big idea here is, how does net income impact capital? So how does net income impact capital? And as you think about that question, how do you think the equity section of a balance sheet is going to change? So let's take a look. So here are some questions I'd like you to consider, or ponder here. What is the impact of the income statement on the balance sheet? Does the income statement impact the balance sheet? How does net income change capital? And how does net loss change capital? So I want you to pause me right now, and I want you to write down your thoughts on those 3 questions. What do you think? All right, got them done? All right, let's move on. Write those down. Okay, so you're going to write this down. This is a formula to update capital. So capital, actually, we're going to have our opening capital. And remember I told you, other than the owner investing money in the business, we're not going to have any changes to capital throughout the period. So the capital is probably going to be the same balance as it was at the beginning of the accounting cycle as it is now. So we're going to take that value, that opening or beginning capital balance, and we're going to either add net income or we're going to subtract net loss. And we're also going to subtract drawings, right? The owner's withdrawal out of the business to get our closing capital. So that at the end of the period, we've updated capital with these 2 values, net income and drawings. So we now know that net income or the net loss figure will come from the income statement and impact the capital account. Therefore, the income statement must be prepared first. So when we're doing our financial statements, after we've completed doing our trial balance, we know debits equal credits, we're then going to complete an income statement, and then we'll complete a balance sheet. So let's look at a couple of examples. So here's the example of Eve Boa that we've already been looking at this over this chapter. And here we've got our owner's equity section. So I want you to notice a couple of things. There's an extra column now. So there's column 1 and there's column 2. And column 1 is going to list our items. So we have our current assets. Current assets are assets that are going to be used up in the year. So used up in 1 year. And long-term assets are going to be assets that have a life greater than 1 year. Okay? And so our bank, our accounts receivable, our supplies are all going to be what we call current assets. We're going to list them in the first column, and then we're going to total them and record that in the second column. We're going to do the same thing with long-term assets. List them in the first column, and then we're going to total them in the second column. And then we take our current assets and our current liabilities and we total them down here. This is the same for liabilities. So again, we've got this column, okay, and on this side it's going to be column 2, okay, and column 3 is this column here. And we also have column 1 that we'll talk about in a few minutes. So current liabilities are liabilities that are going to be paid in less than a year. Okay, and then we have, and in this case here, we don't have any long-term liabilities, but if we did have some long-term liabilities like mortgage payable, okay, mortgage payable would be a long-term liability, they would be listed in the second column and totaled in the third column as well. So now this is the important part. We're going to get down to this owner's equity section that is right here. So in the owner's equity section, we have our opening balance and the opening balance of the capital account. So now we've got two titles. We've got owner's equity, and then we have Eve Boa Capital. And below that, we write down the balance at the beginning of the period. In this case here, it's January 1. And so on January 1, the balance is $21,878. And throughout the period, this comes from the income statement. So this value comes from the income statement, and we know that the net income is $8,209. So we're going to put that in the first column. And then we're going to say less drawings, because we're going to subtract drawings from this. And we're going to put it in brackets because we're going to show that we're subtracting these two numbers. So we take 8,209 and subtract 3,950 to get our increase in capital. If this number is positive, then it's an increase in capital. And so this is the change in capital. $4,259, because we made $8,000 and the owner took out $3,900. Therefore, the increase in capital, or the amount that's staying in the business, is $4,259. So we take this figure, opening balance, and we add the increase in capital to then, in the third column, write that total. So this is the balance in the capital for January 31st. So this balance sheet is for 1 month. Okay, so this net income, this net income is for 1 month. Okay, 1 month. And therefore, the balance is January 31st, and it's $26,137. So we take our total liabilities, and we add our total equity, or our capital, and that gives us our total liabilities and owner's equity. Remember, this and this must be on the same line to show that assets equals liabilities plus owner's equity, and those two numbers should be equal. If they're not, we've made a mistake somewhere. So let's look at this a little closer. So just like I mentioned, here's the owner's equity section. Okay, so owner's equity, we have our opening balance. In the second column, so this is always written in the second column. Okay, third, and this is the first column. In the first column, we're going to subtract these two figures. So net income, okay, subtract drawings, gives us our increase in capital. Then we take this figure and we add this figure to get our closing balance of capital. So now we're going to look at a couple of examples. So here's an example for T. Smith Capital. And so the opening capital balance is $76.64. So that goes in the second column here. Okay, and in the first column, we're going to record the net income. That's this figure here, and it comes from the income statement. So $10,000, $594.03. And our drawings, which is going to reduce capital, so we're going to put brackets around it. Okay, and then we're going to do a calculation. So we're going to take our opening our net income, and we're going to subtract our drawings. And that's going to give me $4,782. So, oops. 82 and 67 cents. So $4,782.67. And so now I'm going to take This is our decrease in capital. So because drawings are greater than net income, it's giving me a decrease in capital. So now we're going to take our opening capital figure, $20,376.64, subtract $4,782.67, our decrease in capital. And that gives us a new capital figure of $15,593. So $15,593 and 97, oops, I think it's 97 cents. And so that is our closing balance at December the 31st, because we know that the net income is for 1 year. Okay, let's do the next one. The next example here has our opening capital balance of $31,216. Our net loss, so this is going to decrease our capital. And we also have our drawings, which is also going to decrease our capital. And the owner can take out more than what the net income is. That's not a problem. The owner can take out as much as $31,000. So we're going to add these two numbers together because net loss decreases capital and drawings decreases capital. So therefore, the overall decrease in capital, we add those two figures together. Okay, so 24,547. So 24,547 and 12 cents, I believe. So now we've got $24,547.12 as our decrease in capital. So again, we're going to have to take our opening capital balance and we're going to have to subtract that because it's a decrease in capital. And so we get $6,669 and, oh, I don't even know what that is. I can't do that kind of math in my head quickly. 31,216.40 minus 24,547. When it goes off the screen, I lose it. 28 cents. Okay, so that's the closing capital balance. And now notice here, the year end is beginning of the year is July 1st. It's for a year. So the end of the year is June 30th, 2016. So the year doesn't have to start on January 1st. It can start anytime through the period. Finally, we have our last example here where the owner has invested some money into the business, $30,000. So we're going to write that in the second column under additional investments. We have our net income figure of $23,604.89, and we have our drawings for the year of $20,000. Okay, we'll put brackets around that. So we're going to subtract these two numbers because net income increases capital and drawings decreases capital. So we want to find the net of it, or what the change is. And so we subtract those two figures and we get $3,604.89. And then what we do is we take and we add all of those figures. So let's do that. You can hear the music in the background because the bell just rang. That's okay. We'll work through that. Plus 30,000 plus our change in capital, which is positive. And therefore, our new capital figure is $86.01.40, or something like that. Whatever it adds up to be. Yeah, I think it's 29 cents. So $80,601.29. And that is it.